The financial advice most people grow up hearing goes something like this. Debt is dangerous. Debt is a trap. Debt is the enemy of financial freedom, and the goal should be to have as little of it as possible, as fast as possible. And for the most destructive type of debt, the kind used to fund consumption, lifestyle, and things that lose value the moment you buy them, that advice is completely correct. But there is another category of debt that the same advice never mentions. The category that the wealthiest individuals and the most successful businesses in the world use deliberately, strategically, and repeatedly to build wealth that income alone could never produce. Debt not as a burden, but as a lever. And understanding the difference between those two categories is the most financially valuable distinction most people never learn. My name is Tomas, and this channel is about finance, automation, and the money strategies that actually build wealth. If you are new here, welcome. Hit that like button right now and subscribe so you never miss a video. Today, we are covering 6 specific ways people become genuinely rich using debt, and exactly how each one works. Let's get into it. Before the 6 strategies, the single idea that makes all of them work, because without it, the strategies just look like justifications for borrowing money. The rule that separates wealth-building debt from wealth-destroying debt. Debt builds wealth when the asset it funds generates a return greater than the cost of borrowing. That is the complete rule. A loan at 6% interest deployed into an investment returning 12% creates a spread of 6% that goes entirely to the borrower. A loan at 22% used to buy a depreciating consumer good creates a guaranteed loss. Same mechanism, opposite outcomes. The debt itself is neither good nor bad. The return on the asset it funds is what determines everything. Every strategy below operates on the right side of that equation. The first way is leveraged real estate investing. This is the most widely practiced form of wealth-building debt on the planet, and the strategy responsible for more self-made millionaires than almost any other approach. When a property is purchased with a 20% down payment, the investor controls a 100% asset with 20% of their own capital. If the property appreciates by 5% in a year, the return on the invested capital is not 5%, it is 25%, because the appreciation applies to the full property value while only the down payment was deployed. The tenant's rent covers the mortgage. The mortgage paydown builds equity. The property appreciates over time. And all 3 of these forces operate simultaneously on an asset that the investor only partially funded with their own money. That is leverage working exactly as intended, amplifying returns on capital far beyond what cash-only investing could produce. The second way is using business loans to generate returns above the borrowing cost. A business owner who borrows money at 7% to hire a key employee, launch a product line, or expand into a new market, and generates a 30 or 40% return on that deployed capital, is not taking on debt. They are executing an arbitrage. The spread between the borrowing rate and the business return goes directly to the owner as profit generated by money that was not theirs to begin with. This is the logic behind virtually every growth stage business financing decision. The question is never whether the debt costs money. The question is whether the return on what it funds exceeds the cost by a wide enough margin to justify the risk. When the answer is yes, and the underwriting is honest rather than optimistic, business debt is one of the most efficient growth accelerants available. The third way is the buy, borrow, die wealth transfer strategy. Wealthy investors hold appreciated assets, stocks, real estate, business equity, that have grown significantly in value. Selling those assets triggers capital gains taxes. Instead of selling, they borrow against the portfolio at low interest rates, using the assets as collateral. The loan proceeds are not taxable income. The underlying assets continue appreciating. The loan is serviced from ongoing income or new borrowing. And at death, the step-up in cost basis in the U.S. tax code resets the capital gains liability on inherited assets to zero. The result is a lifetime of accessing wealth through borrowing rather than selling, paying interest on loans rather than capital gains taxes on sales, and passing the full appreciated value of the portfolio to heirs with the tax liability permanently eliminated. It is not a loophole. It is the tax code functioning exactly as written for investors who understand how to use it. The fourth way is acquiring existing businesses through seller financing, buying a profitable small business using the seller's own financing, where the seller accepts a down payment and receives the remainder over time from the business's ongoing cash flow, is one of the most accessible forms of leveraged wealth creation available to individual investors. The buyer deploys a fraction of the purchase price as a down payment. The business generates the cash flow to service the acquisition debt, and after the loan is repaid, the buyer owns a fully income-generating asset, having deployed only a small portion of the purchase price from personal capital. A business generating $150,000 annually in profit, acquired for $300,000 with a $60,000 down payment, and seller financing for the balance, produces an extraordinary return on the invested $60,000 once the debt is cleared, funded entirely by the business that was purchased with it. The fifth way is using margin strategically during market dislocations. Sophisticated investors maintain access to margin, borrowing capacity secured against an existing portfolio, not to use routinely, but to deploy selectively during significant market dislocations. When markets fall 30 or 40%, the investor with margin capacity can purchase additional assets at dramatically reduced prices without liquidating existing holdings to raise cash. When the market recovers, and it always has, the assets purchased at the discount generate returns that far exceed the borrowing cost of the margin used to fund them. The key is using this tool surgically rather than habitually, with strict limits on the total leverage employed and the ability to service the margin cost through existing income. The sixth way is using tax-deductible debt to fund income-generating assets. Interest paid on debt used for investment purposes is tax-deductible in most jurisdictions, which means the after-tax cost of that debt is lower than the stated rate. An investor borrowing at 7% in a 37% federal tax bracket has an effective after-tax borrowing cost of approximately 4.5% after the interest deduction. If the investment funded by that debt returns 8, 10, or 12% annually, as diversified equity portfolios have historically, the investor profits on the spread between 4.5% and the investment return, while also reducing their current year taxable income through the interest deduction. Real estate investors compound this advantage further through depreciation deductions that offset rental income, creating situations where a cash-flowing property produces no taxable income on paper, while generating real monthly cash flow in practice. The tax efficiency of investment debt. So there are the 6 ways people become genuinely rich using debt. Leveraged real estate, where tenant income funds a mortgage on an asset appreciating on its full value. Business loans deployed into returns that far exceed the borrowing cost. The buy, borrow, die strategy that accesses wealth without triggering capital gains. Seller-financed business acquisitions that use the target's own cash flow to fund the purchase. Strategic margin deployment during market dislocations to buy assets at discount prices. And tax-deductible investment debt that reduces the after-tax borrowing cost below the investment return. None of these are reckless. Every single one requires discipline, clear math, and honest underwriting. The difference between debt that destroys wealth and debt that builds it is not the amount borrowed. It is the return on what the money does next. If this video changed how you think about debt, please hit that like button. It genuinely helps this channel grow. And if you are not subscribed yet, click that button right now so you never miss what is coming next. See you in the next one.